Good evening. Ira Epstein of Linn Associates with your SPDR ETF wrap-up. And this is for Tuesday, the 17th of November, just getting on to 7 p.m., believe it or not, Central Time. I apologize for first not putting out a morning flash. I was so busy in the futures markets, couldn't get away for it to create my morning flash that everybody looks at on the futures. And I am not going to hold my live webinar this week. I want to do my special report, one more of them this week, so I need that time. Today just took my whole day away. I was writing to my subscribers too much and going back and forth with the trading. So that is very important. So we're going to do it on Monday. So as I said, you'll get something in the mail, not just yet. I've also, for the government employees out there, I have added in my subscriber video your different market indices and so on that you're allowed to switch between in your 401ks from the government. So that is done in that. I'll talk more about that over the coming days. But suffice to say, it is a marketplace that is getting overwhelmed with lots of data. First, COVID is out of control. It's that simple. In Illinois, more shutdowns happening today. Now, if you go to a gym, 25% capacity, more things you just can't do. We're this close to being shut in. And then there's trying to get the kids back into school in January. I get it, but the teachers union is fighting, and you're going to have this across the country because we still don't have things that are safe. It's that simple. My wife went today for a COVID test. 20 minutes you have to wait in Chicago, and we have lots of testing sites, and she'll get her results in a couple of days. All right, but we do that regularly, and you have no choice. She's in retail, and she's still working, and it's just a smart move. So as we look at the markets, let's go to the charts and let the action talk. We still have a gap down here. I am not saying it has to be filled. Why? Because the market is still trading over some key moving averages. If the market were under those averages, this would be a target. That's the key to me. When I look at what the chart pattern is, the market pattern is still one of higher lows and higher highs. Bullish. The definition of an uptrend, higher lows, higher highs. Downtrend, lower highs, lower lows. When they end, it's not uncommon that you get, if it's in a downtrend, first the lower low and then the higher high. In an uptrend, if it ends, you'll be stuck with the high and then a new lower low. That's the way to look at it. I filter everything with moving averages. So, because the market is over the 18-day average of closes in red, we'll call it 18-day MAC, 100-day moving average close, 200-day. Because it's over that, the bias is up. Often, you'll get this number above a last swing line low, and that's a better sign of strength. This is nice that it's up here, but this market under 119.95 has the possibility to retest that 18-day average of closes. Where's the resistance? You hit it back here. That was the first time you hit it at the upper Bollinger Band, and the market hasn't revisited it since. Where's the momentum? Overbought. Think of it this way. You have a checklist. And on that checklist, you're looking to see where's the market in relation to the 18-day average, what's the swing line doing, where are my resistance points, where's my stop out point, where's my dollar risk, and what is momentum doing. And each part is very, very important. And if any of those parts don't meet your criteria, I'm going to ask you a question. Why are you making the trade? If they all meet the criteria, win, lose, or draw, why aren't you making the trade? Got it? So it's how to pull the plug and how to hold your finger off pulling the plug. It's a two-part step. In this case, that overbought bothers me. In SMH, the trend is clearly higher lows. We've been with higher highs, again overbought. So for new money, why are you pulling the plug if you're overbought? That's all I'm saying. XLI. Market is overbought, has a lower and low, higher high. That doesn't mean you can't go higher. It's a question of what are the pros going to do now in the market. I'm a pro, and I guess you define pro, my definition, been around this 50, I started in 69, became an avid chartist in '70, actually began charting in the 1960s in our Treasury club at my high school. And by the way, Hillary Clinton went to my high school. She was the year right behind me, and we were on student council and knew a lot together. Harrison Ford also went to my high school. There's more people, more and more, but interesting. In any case, a pro is one that does this for a living. A pro is one that keeps doing it all the time. That's my definition. I don't think the pros buy into that. That's all. That doesn't mean I'm right. That's what I think. There's also a gap in the chart right here. You might want to fill that. Does it mean that I'm bearish? Absolutely not. It means I'm finding reasons to have caution for deploying new positions. What about XLE? Well, you hit my targets. You hit the 200-day average. You hit the Bollinger Band. Back here, you hit the 100, backed off, and then went on to the 2. Doesn't mean you can't go higher. What about slow stochastics? Well, these are the slow stochastic numbers. If those numbers stay over 80 for several days or more, they change character from being overbought to what my term is embedded. I could have used the term locked in. I decided to go with embedded. Here you have today both numbers over 80, over 80, over 80. They are embedded. Which means to me that even though you're there, I think the pros are aggressive buyers in an area maybe even as close as the 100-day average. Why? Because resistance points that you eventually clear often, can't use the word always because it wouldn't be accurate, often become support points. An embedded reading says to me, Ira, you look at this market, find a way to enter until that is lost. When I come to the energy sector, was that what we just did? Let me just check this. Yeah, that was the energy. A chart's a chart to me. I don't even look at the names on them. By the way, that is something I recommend you do. Get away from looking at the name on the chart. If you keep doing that, you come to the table with baggage. What does that mean? It means you have a preconceived idea. I know you're going to tell me you don't. Nonsense. You do. That's my attitude on it. In any case, higher lows, higher highs, bullish. Over the 18-day average, bullish. Problem, overbought. Emerging markets. Everybody wants to be long this. I get it. But this is all I care about. It's embedded. I agree with them. On pullbacks in this market, I think the market is going to be well supported until that red line closes back under 80. When that occurs, I look for a correction to set in. Until then, I think the first deep breaks in the market, especially ones that fill gaps, and you have a gap here between, just so you know it, right here to the next day. I think those numbers are where the pros will be looking to keep entering, looking for higher highs, maybe even eventually up to the upper Bollinger Band. Now that Bollinger Band is growing to the moon. When that happens, it often means you're not going to hit it again. So you go to another study that I don't show here called window envelopes, and I find them very, very helpful. In the gold, you went up to the key resistance, the 18-day average of closes, and that's what I call the line in the sand. The market's got problems. You've got higher lows, higher highs, but you're staying under that number. So the bias is down, the swing line is up. To get friendly, you need this market to close over that 18-day average of closes. Then the next resistance is going to be the 100-day, and if you can clear those hurdles, then I'm looking up here. Right now, I have nothing. GDX, the pattern has been one and is one of lower highs, lower lows, which is bearish, but you're oversold. It's a flip-flop of the others. Now you're too oversold that I think the smart money's not going to deploy new money to sell into that market. TLT, today was a change. If you take a look at this chart up until now, the market had a pattern of a higher high and a lower low. Then it came up and fought the battle at the 18-day average. Very similar to the gold chart that we just looked at. Today, the market gets up and gets through that number. I think the bulls took control of the market. I think they have to support 158.53, and if you get back under 157.61, the market goes into this tizzy where it has no trend at all because you'd have a higher high, lower low. Momentum is up, bias is up, trend is up. In FXE, the euro, the market now has a pattern and has had one of higher lows, higher highs. However, it is long in the tooth and getting overbought. Be cautious here. This market's not reaching for that number, and that's a problem as I see it. The market might want to get a bit of a correction under its belt, but the overall trend is bullish until you take out this 110.45. That doesn't mean you can't get corrections along the way. One of the things during the day that I look at for I call it swing trading. I'm certainly not a day trader. That is not something that I teach or want to do. Swing trading is a trade you put on that can last days, weeks. You don't know what it's going to turn out to be until it ends. That's, to me, a swing trade. Weekly charts are not swing charts. Weekly charts are position charts. There's a difference that you're doing there. Swing trading is looking at day-to-day actions. And very frankly, the longer-term trader, why is he looking at the day-to-day action? He should be just looking at the bigger picture there, whereas the person that's the swing trader, which I am, I define myself as that's the mode I fit in. One of the tools I use for exiting a position or potential entry, but most of the time it's exiting, are called pivot points. What a pivot point is, it's a formula that uses the previous day's range to develop the white line, the pivot point itself. I create a video on this. I have a 3-part video series that's free to you, and it shows you where that number is. That's your neutral point. Again, the line in the sand. When the market goes up, the first sell or resistance point is here, the second one here. First buy point here, second one there. You are not going into the neutral point trying to get back up here or coming in from the neutral trying to get down there. When the market gets to, say, the first sell, you're trying to get short, trying to cover back at that number. For traders that use pivot points, they're out by the end of the day if they're day, and most of them are day traders. That doesn't mean the concept doesn't help you hone your entry points or exit points. It does. I tie it together with my slow stochastics, which most people don't even understand. And what that does is it gives me, and I take that and I look at the timing that the market might be offering. And when I come to the timing, I'm looking overbought, oversold, or embedded or not. What's the market doing and where does it come in? To find out and see how this all comes together in the free 3-part video series, just go to our website, sign up for it under the free offers, away you go. If you'd like to sign up for my research, go onto the website, and at the top on research, read about the different programs we have. You're in there as well. So as I was saying, I'm going to be doing another special report this week for the futures, but they all tie in with the TLTs and the other markets. That's why I do so many of them on that, because at the end of the day, the ETFs are reliant on what's going on in the futures. It's not the other way around for many of them. I'm Ira Epstein. You have a great day. I'll talk to you tomorrow.